Nick, good to see you. Big news. Secure Act 2.0
Wow.
finally passes. So this is going to bring about a lot of changes to retirement account rules. We're going to break down the big takeaways, including some unique opportunities and some changes to tax planning. So we've heard about Secure Act for a while now. What's new here and who's affected?
We hear about it for a while because back in 2020, it was called Secure Act 1.0, right?
Yep.
We just called it Secure Act. So now this is 2.0. And I think we're used to like iPhones, and when we get an upgrade, we think, this must be better.
Yeah.
The thing is, we're still trying to peel away of what all this means and what it was. It was part of that $1.7 trillion omnibus spending bill that they passed at the end of 2022. I think the president signed it when he was in St. Croix or something crazy like that. And so it passed, it went in, and now we're still trying to figure out all that this means. But you and I have met with Ed Slott, who's been on PBS. He's a CPA. He's known as Mr. Taxman. He's like a tax guru. So I pulled off just a couple articles of what he's saying about this whole thing as his team's diving into it. And one of the articles here says, pay attention, Secure Act 2.0 dates are all over the place. We'll get into why that is in a minute. Investors Business Daily, they came out and talked about this and said the fine print in many of the new provisions tarnishes their luster. Several don't even take effect right away, sometimes not for years. Speaking of which, like 401ks, that's one of the big things that got a lot of news on this was 401ks. The big news is that you'll be auto-enrolled into a 401k plan. And so some people are going to mistakenly think auto-enroll. That means everybody. Nope. It doesn't even take effect until 2025, and it only applies to new plans. So there's a lot of gray that we're finding with this. So it's not black and white like we would hope. Right. And so that's one of the things that we're seeing.
Well, that's why I have you, Nick. We are making it black and white in a lot of different ways.
Trying.
All right. Something that, though, is very significant, a new RMD age table. What do we need to know here?
Yeah, RMDs. So here's what ended up happening. When we looked at everything, it used to be 70.5, right?
Right.
People still come into the office and say, RMDs, it's 70.5 and I have to take it. No, back in 2020, they changed it and they made it that the required minimum distribution age was 72. But now it's 73 and it's heading to 75 by 2033. So just like you have right here on the chart, the easiest way to think about this is if you're, and this is going to confuse a lot of people. I think a lot of CPAs are going to be confused about this too because of how it's phased. So if you turn 70.5 before 2020, you're probably taking your RMD. You should be. And you still have to take it. So just because they changed it doesn't mean you can stop if you already had to take it. Now, if you were born 1950 or earlier, that RMD age is 72, meaning you're taking it and you still have to take it. Now, if you're born between 1951 and 1959, the RMD age is 73. And if you're born 1960 or later, the RMD age changes to 75. So what required minimum distribution, if you don't know, what that means is the date at which you have to start taking money out of your IRAs, 401ks, 403bs, those pre-tax accounts. Government's going to tell you, you're 73, you got to take out X amount of dollars, whether you want to or not, out of those accounts. You got to spend it out or at least withdraw money from that so that the government can start taxing you on it.
Yeah, they want their money too.
They do.
All right, next, QCDs. Some changes here. We've talked about those before.
We have qualified charitable distribution. And so, and something else, you know, I want to touch back on something on the RMD too. That I mentioned. I'll come to QCDs in a second. And that's the penalty on it. One of the big things that happened is it used to be if you didn't take your required minimum distribution, that there was a 50% penalty for having not taken it. Ouch. And it was never got assessed much, I think, because it was a 50% penalty. Well, now it's a 25% penalty, and it can actually be 10% if you ask for forgiveness. And I'm thinking you probably have to ask for forgiveness within 2 years. File a form, say, oops, I'm sorry, mistakenly did this, didn't take my minimum distribution, and the penalty might be as low as 10%. But you can bet your sweetie that they're going to increase the amount of people that are going to get penalized because they just hired 86,000 IRS agents. And now that the penalty is only 25% or 10% versus 50, you can bet that they're going to start penalizing people at a greater rate now. But going to QCDs, going back to that, Qualified charitable distribution is basically where you take your required minimum distribution and you can have it sent to a charity. And then that way you still get kind of a deduction. So you take money out, say if 5,000 out as an RMD, you send 5,000 to your charity and it's a wash. Well, there used to be limitations. The limit was up to $100,000, but now what they're doing is they've expanded it to where they will change the limit that you can put on QCDs upwards as it's indexed for inflation. So that's a pretty exciting thing. I like the fact that they're not taking the QCD and getting rid of it. At least they're expanding it, and that's good news.
Mm-hmm. Now, something that's important to, I think, almost all young parents, some really significant changes to 529 plans. Actually, this kind of affects a lot of people, more than just young parents.
It does, because what happens if you have this 529, then what happens if it didn't get used? And so now it can be rolled over to a Roth IRA, but the max is $35,000 that you can put in, that you can take from that 529 and roll it into a Roth IRA, which grows tax-free. But speaking of Roth, one of the 401k things that was really kind of cool is that they are now going to allow employers to match you on your 401k. They can now match you on the Roth side. It used to be in the past that if you contributed to a 401k, when you contributed it, your money, you could say, I want to contribute either on the Roth side or the pre-tax side. But the employer's contribution was always pre-tax. Now they're changing it to where you can put on the Roth side if you want, but now the employer can as well. So that's kind of an exciting wrinkle. We'll see how that one works out and what the rules end up being. Mm-hmm. But that seems like that could be something that's really exciting to help people create tax-free wealth.
Mm-hmm. So these are significant changes. I'm glad we're kind of stripping out the headlines, but I just want to circle back on one topic, that being the RMD age table, because this will, as you mentioned, allow our account balances to grow, but it leaves you with essentially a bigger pot at the end. And so Congress did strip the lifetime stretch IRA rules. So almost all beneficiaries must take out the entire balance in 10 years. That is quite the tax burden.
It is, because so later RMDs might sound good on the upfront, but then your account value is higher. Right. You're older, so then they're going to make you take out more, which means higher required minimum distributions, which that doesn't sound too good, especially when that could push you into a higher tax bracket. It may mean that more of your Social Security is taxed. So there's a lot going on there. With that. But, as you said, with required minimum distributions, and when you have to take those out, that 10-year, what they call the 10-year emptying rule, it used to be that you could spread it out over your lifetime. If you inherited an IRA, you could spread it out and take a little bit every year over your lifetime. Now, if you're a non-spouse, meaning a kid that you inherited an IRA from your mom and dad, you have to spend that down over 10 years. And it's taxed as ordinary income. So if you're inheriting this, you don't have a choice. You can't really be tax efficient. You're going to have to spend it down, and that could make really your IRAs, your 401ks, those big things that you think, I'm leaving a great inheritance, but it could actually be a big retirement ding in the future. So that's why what you want to look at for helping out your family with this is look into maybe converting some of that money to a Roth. Mm-hmm. You can take it, pay the taxes on it, cleanse it of its taxes at current rates, which are probably lower than they will be in the future. And then that money moves from what we call the tax later bucket to the tax never bucket. And then that way that money can pass on to your beneficiaries completely tax-free, mm-hmm. which can be a very, very nice thing to pass on your IRA, but then also some tax-free wealth as well.
Right. So again, that strategic tax planning is very important. Is there anything else you want to mention in regards to tax planning other than, Roth conversions?
Well, I'll tell you what, something else that people need to be aware of that was changed on this was this pre-59.5 federal excise tax. A lot of people know that if I took money out of my IRA or 401k pre-59.5, I'm going to have a 10% penalty because I'm taking it out before 59.5. There was that age. Well, the thing is, they made changes to that now to where there's some availability to that money without that 10% federal excise tax. You're still going to get penalized if you take money out, or you're still going to be taxed if you take money out before 59.5, but you'd have this federal excise tax that you had before. But now there's different things, different reasons why you might not have it. And I printed off a couple of these, and this is how confusing Secure Act 2.0, I believe, is going to be. Because, for instance, they have a section 115. It allows withdrawals from IRAs or those kinds of accounts without that federal excise tax of up to $1,000 a year without penalty for plans and IRAs effective 2024. Then there's section 314. It allows for up to $10,000 of withdrawals from plans and IRAs for domestic abuse. And then there's section 326. You can take withdrawals from plans or IRAs if you have terminal illness. I'm just saying, I'm looking at all this like, who's going to know all this?
Yeah.
Thank God we're in an era of computers. I'm sure somebody's working on it already, because I think what we're going to end up finding out is that they passed it. They got this thing going, and this thing is going to have so much boilerplate and other stuff. It's going to make it more confusing than helpful.
Boy, well, I'm glad that we can have this conversation now. And again, I think the earlier that we can have these conversations with people who are experts, because of course, this is so much to try and understand. Yeah. What's the best way to reach you though, Nick, if somebody does want to talk about any of these proactive plans that they can put in place now?
Well, two things they're definitely going to need to do is get a RMD report done. You got to find out how much these required minimum distributions, now that the RMD dates were pushed back, how is this going to affect you, not just this year, but in 5, 10, 15, 20 years. So you definitely want to get an RMD report and a tax x-ray done so you know how this is going to affect things like Social Security and what your lifetime tax is going to be. So now this is opening up a whole bunch of different conversations. You can always give us a call here and set up a 15-minute strategy session call where we'll just kind of figure out if this is something that's going to affect you. And that number is 844-GROUP-10. Of course, you can go to our website too, group10financial.com. There's lots of information and free things there that we're going to be coming out with this year, because this is big. And as time goes on, we're going to be coming back to this and probably saying, oh, look what we just learned in the Secure Act 2.0, and here's how it's going to affect you, because this is literally affecting most Americans.
Absolutely. All right, Nick, thank you so much for your time today.
Great being with you, Erin.